Good morning, everybody, and hello out there in TV land. Do you remember when they used to say that? Did I just show my age a little bit in saying that? Good morning to you, or good afternoon, depending on where you're joining us from. I'm Rachel Neighbors, and you are here for the Neighbors Group and Solo401k.com open Q&A session. Before we get started, we always do this. I just want to make sure that you can see and hear me. So probably on this side of your screen, you'll see a chat bar. Just let me know, yes, I can see you. Yes, I can hear you. Maybe even let me know your name and where you're joining us from. We have clients all over the country and several expats in about a dozen countries around the world. Sometimes there's a bit of a delay here, so just let me know you can see and hear me. Awesome. Thank you, Marie. I appreciate that. Okay, so awesome. Thanks, Clayton. We've got a lot of questions. So I'm going to go ahead and dive right into those now. Really what we wanted to do with today's session is have, like office hours. We wanted to have an open session where you can ask questions, get them answered, and, just in case you're wondering about the various ways that you can post questions to us, if you haven't yet joined our network at solo401k.net, I highly recommend that you check it out. There's a lot of great conversation that happens there about all different types of investing. People talk about non-recourse loans for their real estate deals. They discuss various crypto brokerage accounts that they are opening and strategies that they are employing. It's just a really good place to share resources with one another, to ask your questions and get them answered. Our experts are on the network every single day. Oftentimes we get to questions there even faster than email. So, and then you can see other questions that your fellow 401k account holders may have had, or maybe even questions you haven't thought of yet. So I know that there's a lot of people that have got these really wonderful questions. Thank you so much. I'm going to go ahead and dive right into them. We've got a lot of questions to get through. We're going to get through as many as possible today. And this is something that we're going to start doing on a regular basis, these open Q&A sessions. So let us know how you're liking this format. And yeah, we'll go ahead and dive right in. Okay, first question comes from Dawn. If I've already contributed more money to the solo 401k than allowed, can I classify the additional contributions as Roth contributions? This is a really good question, Don. I would need more information to answer that for you. And really, this is a question for your tax professional. So you're going to want to discuss with them how much did you contribute and to which bucket. Remember, solo 401ks have two types of contributions that are allowed. There's employee contributions and employer contributions. Employee contributions can be 100% of your total your net compensation for the first $19,500 that you're making in your business. Employee contributions are the only type of contributions that can be Roth. So if you've maxed out your employee contribution, you can't just put more in and call them Roth contributions. This is why, contributions are quite nuanced. It's something that I think is really important for you to talk to your tax professional about. They will be the ones to guide you and let you know how you can reconcile that situation. But one thing that I want to do here, I'm going to share my screen quickly because we have a lot of resources that will be available for you guys. So, and I'll put some of these in the chat as well. So this is a blog post that we have on our website at solo401k.com. Oops, I went to the wrong one. I really want to look at over contribute. Here, this is the one that I was looking for you, Don. And I'll post this in the chat as well. This is going to walk you through what happens if you over contribute to your solo 401k plan. The long and the short of it is, it's not necessarily easy to classify those additional contributions as Roth. There's a larger conversation that has to happen with your tax professional where you guys need to look at what you've contributed already and then see if it's possible to reclassify those contributions, or if you simply have to back out those contributions and pay the taxes on them. So make sure you talk to your tax professional. If you don't have a great tax professional, let me show you how you can find some of those resources. I'll share my screen again one more time. On our website, solo401k.com, you can also get to this. I'm going to show you the knowledge base. You can also get to this from your 401k dashboard. So you can just click on the support link, or you can click on knowledge base. Both will take you to the same place, which is our knowledge base at support.solo401k.com. All I did is type in CPA. And right here, Don, is our updated Solo 401k Literate CPA list. So if you have a question about your contributions, if you've over contributed, you're not sure if you're able to reclassify those, back them out, etc., you need to talk to your tax professional. If you don't have a good tax professional, reach out to someone on this list. That will be a good way for you to get started. I did see one question here from Sylvia. You were asking about the address for the Solo 401k network. You can find that at solo401k.net. I'll put that in the chat as well. solo401k.net. All right, next question comes from Craig. I understand the deadline has been extended to May 17th of 2021 to make contributions for a 2020 solo 401k, or make contribution for 2020 to a solo 401k. But does that plan already need to be existing? Or what is the deadline for opening a solo 401k account to accept a contribution for 2020? Roth is what I want to open. Well, you're in luck, Craig. The deadline to open and fund the solo 401k is now May 17th, with a caveat. It depends on your business structure. So that May 17th extension is for individual tax returns, and then that sort of, filters out to sole proprietorships, single member LLCs, people that are earning 1099, freelance, independent contractor income. Because if you have one of those business structures, single member LLC, sole proprietorship, 1099, independent contractor, you're showing that income on your personal 1040. And that 1040 tax return is what has been extended. So Craig, if you have one of those business structures, then yes, you can open the solo 401k by May 17th and fund it for 2020. If you have an entity, also C-Corps, I actually don't know if the C-Corp extension has been, or the C-Corp deadline has been extended as well. I've only seen it for the 1040. So regardless, if your business is an entity, multi-member LLC, S-Corp, C-Corp, then you can also file an extension for those tax returns. And you can open and fund your solo 401k up until the extension deadline. So Craig, for you, the first question is, what type of business do you own? If you have a sole proprietorship, single member LLC, 1099, independent contractorship, you automatically have until May 17th to open and fund a 2020 solo 401k with 2020 contributions. If your business is an entity, like an S-Corp, for example, you only have a bit more time if you filed an extension for your S-Corp. If you've already filed taxes for your business for 2020, no more contributions to the solo 401k plan. And that is, with or without the extension. So if you have a 1099 sole proprietorship and you already filed your taxes for 2020, then you can't make any contributions for 2020. That tax filing is the cutoff. Okay, I think people still had some questions about the CPA stuff, so let me share my screen one more time. Guys, the way that I got to this is I clicked on support on our website, solo401k.com, You can also get to this from your 401k dashboard by clicking on the support link. And then I just did a search here for CPA. So I'll go ahead and post that in the chat as well. There you go. And JB, I see you've got a follow-up question here. I'll go ahead and answer that, but we do need to stay on task with all the questions that we have pre-submitted. JB says if you extend the May 17th date, would you be able to fund until the later extended tax filing date? Yes. So you'll have until October 15th to set up and fund the 401k for 2020. It's pretty cool. This is a new rule, just started this year, but so it's pretty awesome. We're really excited about it. Okay, thanks, Craig. Appreciate that. Next, Jason said, I just created my solo 401k plan this year in March of 2021. I contributed $37,500 toward my SEP IRA plan last year for 2020. Could I still contribute to the solo 401k plan anyway? $19,500 from the employee's side or personal account directly into the tax-deferred solo 401k, or $19,500 into the Roth solo 401k from the employee side. The answer is probably. Probably yes, you can. It really depends. So again, contributions are always, I think, the stickiest part of 401k plans. They're the most complex, certainly. That's the whole point of employee benefit plans, is to be able to put money away. So it's going to have the most nuances. And I've got a blog post here for you, Jason, that I think will help, which is, can I contribute to a SEP IRA and a solo 401k at the same time? The answer is yes, but there is calculations that have to be taken into account. So there's a good possibility you can still make employee contributions, but there are other factors that need to be brought into the mix, such as if you have already, if you've made enough contributions to your 401k plan. Or excuse me, if you've made enough income in your business to support those contributions to your 401k plan. So that's really going to be a question for your tax advisor. They will need to walk you through those numbers and see what might make sense for you. And again, Jason, I did post that blog post article link for you in the chat, so you can check that out. Thank you, Jason. All right, next question is from Mogu. Mogu asks, if a business changes from an unincorporated sole proprietorship to an S-Corp in the middle of the year, how should contributions be made and reported to the IRS to maximize tax deferral benefits? Well, it seems like we should probably do our next training on contributions, because they're a bit of a mind melter. So Mogu, this is going to be a question for your tax professional. I know I sound like a broken record, but it's because that's their job, is to help you defer these taxes, pay less in taxes, and to really know the tax code in and out. You know, of course, I should have said at the beginning, this is not tax, legal, or investment advice. Here's the big disclaimer. Just jumping onto a Q&A session is not a replacement for working closely with your tax professional. If you don't have a tax professional, get one. They're so totally worth it. You have a solo 401k because you're running a business and you want to be making profitable investments in your retirement plan. That means you need a tax professional to help you out. That's their job. They're worth their weight in gold if they do a good job. So use that list that we posted in the chat to find a solo 401k literate CPA, because Mogu, they will go through with you the exact procedures and protocols for you to be able to support this. I am not a tax professional. I am not an accountant. What I would say, answering here, not as an accountant, is that you'll probably have to shift from getting those 1099, the income that you're showing on your Schedule C, which is your profit and loss statement from a business. That's what most unincorporated sole proprietorships use. A Schedule C, that's where you show your income. If you switched mid-year to an S-Corp, then as soon as you make that election, you're going to have to start issuing payroll to yourself and paying payroll taxes And then at the beginning of the next year, you'll issue a W-2, or your tax professional will do that. Probably what will happen is you're just going to look for your calculations on what you earned as an unincorporated sole proprietorship and make your calculations and contributions based on that income. And then when you flip over to that new structure of having the S-Corp, then now those contributions are made based on your what will be W-2 and payroll. But making sure that that is a smooth and elegant transition, and making sure you don't accidentally over contribute, is why you need to get your tax professional involved. So, great question, Mogul. Thank you. Okay, next up, Beverly. I turned 70 this year. Happy birthday. And I'm wondering whether I need to take mandatory distributions out of my solo 401k. And if so, starting when? And how much I need to take out each year? And can I contribute to the solo 401k after age 70 or not? And defer federal taxes to a later date? Good questions, Beverly. I'm going to look for a couple of things here on our knowledge base. So I'll pull up that screen again. I know some of you were saying that maybe the screen share is too small. If you are joining from a desktop, which is what we always recommend, then you should see now that the screen I'm sharing is much larger, and you'll see me sort of tiny down in the corner. If you are joining today's webinar from a mobile device, which we do not recommend because the viewing experience isn't as awesome, and yeah, you'll need to minimize the chat because already you're looking on a smaller screen, and now I'm going to be really super tiny, and this is all that you're going to be able to see. So if possible, we would strongly recommend that you join us from a desktop. That's going to make your user experience much more awesome. But okay, I want to pull up a couple of articles here for you, Beverly, so that you can look into this a bit more. So required minimum distributions, those are RMDs. That's what you have to start taking. Actually now, age 72 and a half. So you'll see there's several articles here that we have in our knowledge base that discuss required minimum distributions. Talks about how to file those 1099s, how to calculate them, etc. So I would definitely recommend, I'll put this as a search term in the chat for you, Beverly. If you click on that link, you'll be able to look at these various articles and get a lot of your questions answered. Again, I will defer to your tax professional. Your tax professional is really going to be the person that helps you out. But to address your questions, if you turn 70 this year, you do not have to start taking your required minimum distributions, also known as an RMD. The Secure Act. Nerd alert. The Secure Act, which was passed in December of 2019, changed a lot about different retirement plans, including allowing the 401k to be opened right up until you file your tax return. That's why this is so awesome, that you now have more time to create and fund your solo 401k, even for 2020. So the Secure Act, that was one thing that it did for us. Another thing that the Secure Act did is it extended the RMD age where you have to start taking these RMDs to 72. It used to be 70 and a half. Why the IRS has us do half years, like age 59 and a half, age 70 and a half, I don't know. I have no idea. But now the RMD age is 72. So Beverly, you do not need to start taking your RMDs this year. You've got a little bit more time. But for those of you who are at RMD age, you'll need to work with your tax professional to calculate. There's a special calculation, and it's based on how much is in all of your retirement plans. It's not just your solo 401k. The IRS makes you take out money of all of your retirement plans, except a Roth IRA. That's the only one that's exempt. But they'll look at traditional IRAs, Roth 401ks, 457s, normal IRAs, normal 401ks. You have to look at all those together. You aggregate them, and then you have to start taking out money, proportionally from each account. So you might take a little out of a traditional IRA, a little bit out of your 401k. They each have to be proportionally taking distributions. Your accountant, your tax professional, will be able to do this calculation for you. There are some links to the tables that the IRS provides. You can find them right here in this article. So how much you need to take out is a percentage of your retirement plan. And that percentage starts small at age 72, and then it gets bigger and bigger and bigger and bigger over time. What the IRS wants to accomplish with an RMD is they want tax money. So they're going to tell you, you have to start taking out a little bit and a little bit more, a little bit more, a little bit more as you age, so that they are essentially forcing you to take those distributions because they know they're going to earn tax revenue on it. And for those of you that might have the question, yes, you still need to take an RMD from a Roth 401k. You don't have to pay taxes on it, but you still have to take the money out of your Roth 401k, which is kind of dumb because the whole point of a Roth 401k is to keep those gains growing tax-free. So what many of our clients do is work with your tax professional, but over time, as you're reaching the RMD age, you can roll your Roth 401k funds into a Roth IRA and avoid those RMDs. Your final question, Beverly, yes, you can contribute to your solo 401k even after you start taking RMDs. The proportionate value of how much you're getting in the tax deductible contributions might change a bit, because let's say you're putting in 30 grand and now you have to take out 10,000. But it is still highly valuable for most people. So if your business continues to make money, then continuing to make those contributions even after age 72 is usually a great idea. Thanks, Beverly. Okay, John asks, can I use solo 401k money for real estate auctions? Yes. You just have to make sure that the 401k is the purchaser. So on the purchase agreement, it's the 401k trust that is the buyer. Good question, John. Spencer asks, do you know if I'm okay to roll some money over from my SEP IRA at TD Ameritrade into my solo 401k without any tax consequences? They are both tax-free accounts, but I'm not sure. Yes, Spencer, you can roll funds from your SEP IRA into your solo 401k with no tax consequences. And I will jump in here. I'm going to share a couple of things with you. First, let me go ahead and log into our solo 401k dashboard here. I'm going to just do a quick login. Give me one moment, and then I'll share my screen bigger. All right, so I'm going to show you a couple of things here, Spencer. First is when you're logged into your 401k dashboard, if you click on this link for rollovers, this will allow you to create a rollover request to send to TDA so that they will issue the rollover check or send a wire from your SEP IRA to your solo 401k. Make sure you watch this video. It's really helpful. It just kind of walks through how to roll over funds, and it tells you exactly how to complete this page. So that's sort of the mechanics of how you would make it happen, Spencer. If we go back to our solo 401k knowledge base, and just as an aside, if I clicked on the support link, it'll take me right back to that same place, that solo 401k knowledge base. So that's a really helpful touchstone for you to make sure that you're able to get a lot of info. And I'm just going to type in rollover. Bam, how to initiate a rollover into your solo 401k. This is going to walk you through exactly how to complete that incoming rollover from your SEP IRA to your solo 401k. Now, one thing I want to note here, Spencer, you were talking about without taxable consequence, which is really important. So I'm going to go ahead and open up. I have a sample rollover packet here for you. The reason why we have you complete these rollovers on your 401k dashboard is we're really clear in the notes that you're going to send to TDA. This transfer is not a taxable distribution to the participant. No taxes should be withheld. We're really, really clear about that. We tell them how to complete IRS Form 1099-R. This way, TDA, who will send a copy of the 1099-R to the IRS, we tell them how to fill it out so that they don't mess things up. And we also even give them a sample 1099-R, and we tell them exactly how to complete that form. If you follow our instructions, Spencer, you should have no issues taking a tax-free distribution or rollover or transfer from the SEP IRA to the solo 401k. Thanks, great question. All right, humming right along. Kenny asks, if I were to retire from my current employer, can I roll over my employer-sponsored 401k plan to my solo 401k? Yes, absolutely. Previous employer 401ks can roll into a solo 401k, no problem. Next question comes from Andre. Andre says, our business is an LLC, and my spouse and I get income distributions through a K-1. Do we need to start paying ourselves salaries and filing W-2s to contribute to our solo 401k, or can this be done directly through K-1 or other means? Good question, Andre. It depends on your business. If you have an LLC that is just taxed as a partnership, then using your K-1 may be possible. However, it depends where the money is showing up on the K-1. Let me pull up Schedule K-1 1065. Give me just one moment here. That way I can share this with you. So if you have a partnership, let me make my screen bigger. If you have an LLC taxed as a partnership, then that means that you're going to issue K-1s to the partners. And what we're looking for here, let me see if I can zoom in a bit. That's nicer. So what you're looking for here, Andre, is you want income showing up in line 14. That's self-employment earnings or loss. This is the line that the IRS will look for to calculate, or for, to verify your contribution calculations are correct. If you're only showing income in line 1 or line 2 or line 3, that does not count towards calculating your contributions. You have to show the income on line 14 if you have a multi-member LLC taxed as a partnership. Now, your tax professional might still think that issuing a W-2, running payroll is a good idea. They may say that above a certain earning threshold, changing to S-Corp election for taxation is advantageous. A lot of accountants believe that once you're making more than, usually it's about 75 grand a year, then switching over to an S-Corp is really a big advantage for you from a tax perspective. So that's a separate conversation that you'll want to have with your tax professional. But if you're just showing the income on line 1 or line 2 on a K-1, that does not count. If you're showing the income on line 14 of the K-1 for your multi-member LLC, you should be good to go. Thanks, Andre. Good question. Peter, looks like you have a two-part question. So I'll show on the screen the second part since I think that's what you're asking. So the first part of Peter's question says, I've opened my solo 401k and set up a bank account at one of the institutions you recommended. Awesome. I funded the account from transferring money from my Fidelity SEP IRA. Hey, there you go, Spencer. See, Peter already did it very successfully. Good job, Peter. Okay, Peter's next question. My question continued. I intend to make a mortgage loan. I think you mean, Peter, that you want your 401k to be the note holder on a mortgage note. If I'm incorrect, put that into the chat, but I think that's what you're probably saying. You want your 401k to be the note holder on a mortgage. My question is, what information is required or recommended to be on the mortgage documents? Good question. We actually did, let me see if I can get a link to it. on our network at solo401k.net. I'm just pulling that up here. I'm going to share my screen with you. I promise I'm going somewhere with this, Peter. So here we are at solo401k.net. This is our free network for everybody. And if you click on events on the left-hand side and go to past, this is where you can see past events, then what I'm looking for here is real estate. As you can see, we've done a lot of trainings. Where is that one on real estate? Aha. Peter, I'm going to put this into the chat for you. We talk about mortgage notes in this training, real estate training. The skinny is that your 401k is the lender or the note holder. So when you're drawing up the loan documents, the 401k trust should be listed as the lender or the note holder. And then you are listed as the trustee. Whether or not you are listed by name in the documents is pretty immaterial, but the 401k trust should be listed. And the 401k trust tax ID number, that's the EIN that we obtained for you when we set up your plan, needs to be listed on the note documents as well. This way, it's the 401k that's issuing the mortgage or holding the note, and the 401k that's receiving those note repayments. It's not you personally, Peter. It's the 401k as an entity that's actually acting as the investor. And of course, we recommend that your accountant or perhaps your legal counsel write the mortgage note so that the 401k is properly listed as the note holder. Good question, Peter. All right. Anthony. Good question, Anthony. So this is a meaty one. Can I, as a disqualified person, partner with my IRA on a real estate deal? My plan is to set up a trust for each property with my LLC and my IRA LLC as beneficial interests or owners. There's some case law below. An IRA and a disqualified person may have ownership interest in the same asset so long as the ownership is fairly allocated, is separate, and does not unfairly benefit the disqualified person. Cherwenka case 13-57592, and you cited a court case. So I'm really glad that you brought this up, Anthony. We get this question a lot. There's a lot of people who want to partner with their retirement plan. And there's no clear answer on this. So I'll share my screen, and I have some resources here for you a moment. You cited case law where a recent legal precedent in bankruptcy court ruled that there was no disqualified person for the IRA and the 401, or excuse me, the IRA and the individual investing together. But there's also case law in bankruptcy court, very similar deal, where they ruled against the account holder and the entire IRA was distributed. So there isn't yet a black and white line. We have from the year 2000 an advisory opinion from the IRS on this topic, the JANOW letter, people call it. Some attorneys have used that to build a case that it's okay to partner with your IRA. Other attorneys have used it to build a case that it isn't. It's an extremely nuanced and complicated area of case law. And I'm not an attorney. So I'm not your compliance officer. I'm not ruling in favor or against partnering with your IRA. I personally wouldn't do it. If you asked what I would recommend to you as a friend or a fellow investor, I would say don't do it. Because for every case law that you can bring up telling me, well, hey, this bankruptcy court, it's usually bankruptcy court proceeding, said it's okay, there's another case disproving it. And there's no IRS tax court and no black and white advisory opinion delineating yes or no. So it's a big gray area. If you look at the Internal Revenue Code, that is IRC 4975, the Internal Revenue Code that specifically deals with prohibited transactions. And these are the same rules for IRAs and 401ks. It's very clear in the tax code that you are prohibited from doing any deals or transacting with a disqualified person. You are disqualified from your own retirement plan. An easy example of this is you can't have your 401k buy a property and then you live in it. That's pretty black and white. You're disqualified from your 401k or your IRA. If you can live in a property owned by your 401k, you stand to personally benefit. That's a no-no for the IRS. It's very clearly a prohibited transaction. But what people have done over the years is they've tried to get creative, and they've come up with this PPO argument, that's percentage in, percentage out. If I create a totally new structure, and this is, we decide it's 50-50 from the creation of the structure, and we're never going to change the capital accounts. I own 50%, my 401k owns 50%. That's okay, right? Percentage in, percentage out. We're not changing anything. Here's the case law to back it up. But then in those exact same instances, there's other case law where it's been shot down. So I'm going to just share a few articles here because I think that this is really important. And I will ultimately give you what my recommendation in these situations so that you have a little bit more guidance here, Anthony. But so this is the JNOW opinion letter I was talking about. It's from 2000. 2000-10A, where they talk about the IRA partnering with the individual. And then here is, Matt, great guy, smart attorney. He talks about how using this specific case that you're talking about, Cherwenka, means that it's okay for these IRAs and 401ks to partner with the account owner. But then there's other case law, specifically the Kellerman case, 50-50 ownership, where it talks about how this was a prohibited transaction. American IRA talked about it, IRA Financial Group talked about it, even a Forbes article. This is Adam runs IRA Financial. So what most attorneys will recommend, if they're not trying to be creative, is it's just not a good idea to partner with your IRA or your 401k. It just dances on the line of the Internal Revenue Code 4975 being a prohibited transaction. And no matter how you try to slice or dice, getting real creative with structures, it doesn't supersede the tax code. So most attorneys will tell you, don't do it. Don't partner with your IRA or 401k. The one instance where it may be okay, I still wouldn't recommend it, but it may be okay, is if you do not need to partner with your IRA at all. So Anthony, let's imagine, just for super simple numbers, that you want to buy a property worth 100 grand and you only have 50 grand in your IRA and you have the other 50 grand personally. You need to partner with a disqualified person to do the deal. It doesn't matter if it's a totally new structure, you're never changing your capital accounts, PPO, blah, blah, blah. You need that disqualified person to complete the deal. In many cases, most attorneys will agree that that could be considered a prohibited transaction. If, however, same deal, you're buying a property worth 100 grand and you have 150,000 in your IRA and another, 50 grand in your personal funds, that IRA is not reliant on a disqualified person to complete the deal. You don't have to do the deal with yourself just to make it work. It's a choice. So I think that there may be a stronger argument against the prohibited transaction in that instance alone. But let's face it, the reason why most people want to partner with their IRA is because they don't have enough money in the IRA to do the deal, or they don't have enough money in the 401k to do the deal. So they have to lean on a disqualified person to get it done. So our takeaway, Anthony, is don't partner with your IRA or your 401k. It's just, there's, for every precedent that you can say, hey, it's okay, somebody else can bring up another precedent saying, no, it isn't. And those don't supersede the Internal Revenue Code itself. If you are going to do this type of a deal, which we don't recommend, but if you are, then we would strongly recommend that you get a legal opinion from your attorney. A legal opinion is expensive. It's usually $5,000 to $10,000. Essentially, what you're doing is having your attorney thoroughly research your case and write and put their name on the dotted line saying they believe this transaction to be valid and not violating IRC 4975. The reason why that legal opinion can be helpful is if you are taken to tax court and if your attorney is incorrect, your attorney's malpractice insurance can kick in to cover that claim. As you can see, it starts to get very complicated very quickly. There's just not a black and white answer on this particular subject. I know that it sounds awesome to be able to, juice the deal by putting in your IRA money or putting in your own personal money and have some of those gains grow tax deferred or tax free. But it's just not as straightforward as one might like to think, even if you've got one case or two cases to back it up, because someone on the other side will be able to tell you, here's a case that negates what you're trying to do. So thanks for that question, Anthony. That's a bit of a rabbit hole, but I'm glad that we touched base on it because I think that that's really important. Okay, next, Christopher asks, what are the penalties for early withdrawal of funds allocated to a traditional IRA? Anytime you take money out of a retirement account, Christopher, you're going to pay taxes. The way that that works is the amount you withdraw is added to your taxable income for the year. So let's say you withdraw $10,000. You add $10,000 to your taxable income for the year because you're taking, personal possession of your retirement funds. If you do an early withdrawal, you have to add a 10% penalty, 10% early withdrawal penalty. So instead of just adding $10,000 to your taxable income for that $10,000 withdrawal, it's really $11,000. That becomes, what you need to include in your tax preparation. Next question comes from Jim. And we've got about 15 minutes left here, so I don't know if we'll be able to get to all these questions. Oh my gosh, you guys, there is like 30 questions. Okay, we're going to try to go through these, maybe do a little bit of a lightning round here. Jim, can you discuss the granularity required for 401k record keeping? Example, one moves Bitcoin or one moves money from Titan Bank to Kingdom Trust to invest in crypto. A week later, some of the funds are invested in Bitcoin. 2 weeks later, some of the other funds are invested in ETH. There's some cash left over. The Bitcoin is converted to a Roth. What's the granularity of this record keeping? You got to keep track of all of it. So with a solo 401k plan, you are your own plan administrator. That means you are responsible for notating or keeping a ledger. This can be a simple spreadsheet, QuickBooks account, but you, Jim, are responsible for keeping track of those funds' movement. So the way that you described that, moving funds into a crypto account, purchasing, having the date that the funds were moved in, having the date that the funds were placed into position, having the following date that the other funds were placed into a different position, a subsequent date of conversion, all of those types of line items are what are required for a 401k administrator to keep the records of the plan. So if you're able to keep those records following that line of thought that you displayed here, Jim, then I think you should be in good shape. All right, Gary. Hey, Gary, can I set up my 2020 solo K in 2021 and still make employee contributions as well as employer contributions? Yes, as long as you have not yet filed the tax return for the sponsoring business. If you already filed your tax return for your business, you can't make 2020 contributions or set up the 401k for 2020. If you have not yet filed your taxes for 2020 for your business, then you can set up the 401k and make both employee and employer contributions. And actually, I'm going to share my screen again. Gary, let's go back to, where is it? Let's go back to the network. solo401k.net. There's 2 trainings that we've taught this year on this exact topic. So the first was the Secure Act. We did this in January with Nate Bush. He's a great CPA. I think many of you probably use him. He's one of our Solo 401k literate CPAs. And Nate taught a training all about how to open the plan and make contributions. So that's on the network under past events, Secure Act and a Solo 401k. And then later we had John Heyer, who we love, come and do a training with us on exactly how to make 2020 contributions, even in 2021. John is fabulous, very well known in the space. Gary, I would recommend that you check out those trainings so that you can see exactly how to make those contributions in 2021 for 2020. Next question from Joe. Are the following investments allowed for a solo 401k? Crowd-funded real estate, Realty Mogul, Fundrise, crowd-funded venture capital like WeFunder, peer-to-peer lending, Prosper? Yes. Yes to all of it. And I have an article here that I brought up for you where we specifically talk about real estate crowdfunding, Fundrise, Realty Mogul, all of those are right here for you. I'll put that in the chat. Joe, yes, you can absolutely invest in crowdfunded real estate, crowdfunded venture capital. I think we have, let me see if we even have an article about WeFunder. Yes, here you go. Investing with venture capital right here. I'll go ahead and post this in the chat for you as well. Got a lot of information about that. Here we go, online resources and peer-to-peer lending as well. Prosper's fine, Lending Club, those are all a go. So yeah, go for it, Joe. Ju asks, my spouse receives 1099 income from one company. He also owns an LLC. During the tax filing, our tax preparer combined his 1099 income and LLC revenue and expense into one Schedule C form. If line 31 on Schedule C is a net loss, can he still contribute all of the 1099 income to a solo 401k Roth as an employee contribution? Probably not. Line 31 talks about your net earnings. If there are no net earnings, then you can't make contributions. So usually line 31 is the amount that you'll use to calculate your contributions for a sole proprietorship or single member LLC. If that's a loss, then there are no earnings and therefore no contributions that would be available. Double check with your tax professional, but I would say if there's a loss on line 31, no contributions. All right. Emily asks, any updates or guidance on purchasing crypto miners or equipment? What are the reporting requirements for a crypto transaction that stays in crypto? Example from a mining LLC partnership and a holding LLC. Good question, Emily. I know that our friend Mark Kohler, he's an attorney and an accountant. He recently issued or put out a video on how your 401k or Roth IRA can sort of inadvertently invest in mining through what we call a UBIT blocker corporation, which can be a C Corp or an LLC taxed as a C Corp. It's a very expensive structure to set up. It's a very complicated structure to set up and requires extra tax returns. That's certainly one route to pursue if you have extra money and time you want to throw at the situation. Otherwise, we do not recommend investing IRA or 401k funds directly into mining or purchasing mining equipment. There's just no legal precedent yet on whether or not mining equipment is going to be considered a business. And there's a couple of potential issues there. If your 401k buys mining equipment, then is your 401k investing in a business that you own, which would be a prohibited transaction, which would mean any of the crypto that you mine is potentially subject to taxable distribution with extra taxes and penalties. That negates the whole purpose of it. So that's issue number one. Issue number two is if your 401k invests in a business, mining in this case, that may trigger something called unrelated business income tax, which means that your 401k, which is typically a tax-deferred vehicle or tax-free if it's Roth, has to pay taxes. Now, that's not the end of the world. Emily, if your 401k is invested in an LLC that does mining, your 401k might need to pay taxes, even on the income coming in from the mining partnership. If the IRS determines or if the IRS views that LLC as a pass-through business, then that means your 401k is one of the owners or members of that LLC and probably is going to have to pay taxes. So our updates and guidance on purchasing crypto miners or equipment is don't do it directly with your 401k. It's a bad idea. What are the reporting requirements for crypto transactions that stay in crypto? So if you're just buying and selling crypto through an exchange, then there's no reporting requirements because there's no tax return for a 401k. However, you need to keep the records of those transactions, like we just discussed with Jim's question. If your 401k is invested in a mining partnership, then the reporting requirements may be that your 401k has to file a tax return and IRS Form 990-T, where it will pay unrelated business income tax. This becomes quite complex quite quickly. So if your 401k is invested in an LLC mining partnership and you are earning income, you got to talk to your tax professional because you're probably going to pay taxes on that income. SJ, how can I invest in Bitcoin using a solo 401k? Great question. There's a couple of ways you can do it. You can have your 401k trust open an exchange. We have several articles in our knowledge base that talk about opening Coinbase and Kraken accounts. So that's certainly something that your 401k can do. We also have something called the Bitcoin Pro Storage account. You can learn more about that at neighbors.com/Bitcoin Pro. I'll put that in the chat here. That really makes sense for if you are purchasing at least $10,000 worth of crypto, and it is not meant to be a trading platform. The Bitcoin Pro Storage program is a long-term buy and hold program. But those are two ways that you can invest in Bitcoin with your solo 401k SJ. Next question from SJ. Can I bring in mine and my spouse's traditional IRA accounts into a solo 401k and then combine the funds into a brokerage account? How do I do this? Great question. So yes, you and your spouse can both bring funds into a solo 401k. However, we recommend that you maintain separate accounts. I'm going to open up an article here on our knowledge base. I just went to our knowledge base and did a search for spouse, and we have a lot of articles that we talk about here. But spousal considerations, this is a good article for you in this situation, SJ. We recommend that you and your spouse have different brokerage accounts. You're both rolling funds into the same 401k, but you'll have a brokerage account under the 401k, and your spouse will have a brokerage account under the 401k. By law, the IRS says that each participant, that's you and your spouse, has to maintain a record of their transactions and their funds history in the plan. That's really challenging to do if both of your money is mushed up together in one brokerage account. Keep one brokerage account for each of you under the same 401k, and it'll make your life a lot easier. Next question. How do I manage conversion of a solo 401k into a Roth 401k? I plan to do this every year. What reporting is required? We'll go back to our trusty knowledge base, and I'm just going to type in Roth conversion. You'll see right here, we've got all of the information that you need, steps, filing, reporting information, right there for you, SJ. That knowledge base article is going to walk you through how to do an in-plan Roth conversion and what reporting is required. David says, I want to use Binance US, given their low trading fees, to purchase my crypto and then transfer my crypto to the appropriate exchange or storage company. Does my Binance account need to be linked to my trust, or am I free to purchase crypto and transfer to the final destination? No, you are not free to purchase the crypto, David. Your Binance US account must be in the name of your 401k trust and use your 401k trust tax ID number. That is a must. There is no way around that. Any account that you are opening that's going to hold 401k funds or assets must be titled in the name of your 401k. If you're opening a Binance account, a Gemini account, a Coinbase account, they must be in the name of the 401k. I will likely place a percentage on my Trezor as well. I believe as long as the sub-account is only for my trust funds, I will not create any tax issues, but wanted to confirm with you. Yes, that's correct. Sandra, if I buy real estate with my solo 401k, do I need to pay property taxes? Yes. Just because your 401k is buying property does not mean that it is exempt from property taxes. You don't have to pay income taxes on the rental income you receive, but you do have to pay property taxes. Sandra says, can I set up a solo 401k as an individual that has no business? No. Solo 401k plans are only for business owners. Now, your business might be that you are a sole proprietorship or an independent contractor. You earn 1099 income. That's okay. You do not have to have an LLC. You do not have to have an S-Corp, but you do have to have a business or some sort of self-employment activity. If you are not self-employed, if you have no business, you have no 401k. And instead, you need to look at an IRA. Jennifer says, I filed an extension for my S-Corp taxes for 2020. Good job. I would like to be able to set up and fund my 401k for 2020 and max it out. Great. Can I do this without running it through payroll? No. I take $35K a year in wages at the recommendation of my CPA. My net profit in 2020 was about $65K. I've already completed my payroll for 2020 and my W-2 is completed at $35K. Good question. So Jennifer, your 401k contributions for an S-Corp are all related to W-2. So I like to look at, I have IRS, FAQ, I look this up all the time. I love to share this link with people. Retirement plans, contributions. Yes, I will link this here for you in the chat, Jennifer. But this is what we're looking for right here. Where is it? Can I contribute to the company's 401k plan or establish a self-employed retirement plan based on my S-Corp distributions? So that's that 65K that you're talking about, the owner distributions. The answer is no. It all has to be coming from W-2. All comes from W-2 compensation. So right here, you can make salary deferral contributions to the 401k based on your W-2. Your employer can make matching or non-elective profit sharing contributions based on your W-2. So you have, oh, I should make that screen bigger for you. You guys probably couldn't even see that. Here, this is the link here, and we're looking at this highlighted section in the middle. So Jennifer, if you filed an extension for your S-Corp, you have a couple of options here. You can open for 2020. Well, actually, you have one main option. You would open the 401k for 2020. Totally fine because you filed your extension. And then you might need to have your CPA amend your W-2 that's already been filed to demonstrate that you're making contributions to a self-employed retirement plan. So that's possible, but you might need to amend your W-2. And I see Mogu just had a little question pop up here. Since we're on the topic of S-Corps, how much of the W-2 wages can be the employer contribution? 25%. Thanks, JB. Good looking out. Yes, JB, you are correct. All right. This question is from an anonymous person. I'm somewhat confused on the paperwork for the distribution and when do I pay the tax and what do I need for filing taxes? I'm not sure what type of distribution you're talking about here, so you'll want to talk to your tax professional. If you're just taking a distribution, a normal withdrawal from your 401k, then you will need to demonstrate that on your tax return. There's a line on your tax return that talks about withdrawals from the 401k, and you'll pay the taxes in the following year. So if you take the distribution this year in 2021, you'll pay the taxes in 2022. And this is definitely a situation where you need your tax professional to help you as well. Looks like we've got time for one more question. And I know there's a whole bunch that are here, but we don't want to make these too long. So I'm going to do one more question. And then what we'll do, guys, is we'll schedule our next Q&A for one or two. Yeah, appreciate that, Eric. Yeah, we'll schedule our next Q&A for either next week or in 2 weeks, and I'll make sure that all of these questions are included in the next Q&A. If you guys would like us to do this same thing, maybe next Wednesday at the same time, just let us know. Right on, cool. Because what we can do, if we do this next Wednesday, okay, you guys are so great. So if we do this, let's say, all right, let's call it. Let's just say we'll do it next Wednesday, same time. I'll go ahead and put it on the calendar. And what I can even do is I think I can add to this session so that we can come back to this exact same URL. I'll add another session so that way we can do this next week. We'll just next week, same time. Okay, we'll do one more question here and then we'll keep it rolling, and we'll definitely meet back here, same bat time, same bat channel. All right, so one more question here from Todd. I'd like to roll over portions of my employer 401k into the solo 401k Roth and do this over several years to manage taxes and avoid RMDs when I hit 72. Can I also contribute the max amounts while doing rollovers each year? Okay, so couple of thoughts here for you, Todd. Can you also contribute the maximum amount while doing rollovers? Yes. There are no limits on rollovers. You could roll over $1. You could roll over $100 million. It doesn't matter as far as your contributions. Contributions, rollovers, two different bags, two different things. Now, your question about rolling over a portion of the employer 401k to avoid RMDs to the Roth is a little more nuanced. So, if your employer will allow you to roll over funds from their 401k into your solo 401k, great. Not all employers do, just so that you know. If you're wondering, how do I find out? You want to ask HR, will you let me do a partial in-service distribution? We ask for a partial distribution, so we're not freaking them out, thinking that we're going to take all our money away from them. And an in-service distribution means, can I have access to this money while I'm still in service to the company, while I still work here? So you want to ask HR, can I do a partial in-service distribution? Usually if you throw those magic words at them, they know you know what you're talking about, and you can probably get a lot farther in the conversation. But they can still say no. Sometimes current employer 401ks will not let you take any of the money out while you still work there. So Todd, you do need to be emotionally prepared that your request may be denied. But let's say that they're cool with it. So I think that what you're trying to do is get the money into a Roth structure to eventually avoid RMDs. And really, maybe what I can do next time is borrow Jeff's whiteboard or his notepad, and we can draw boxes and arrows together. But essentially what you'll do is you'll roll over pre-tax to pre-tax, okay? 401k to new 401k. Then you convert it to Roth. And I know I need a whiteboard or something to write with you guys. For today, we'll do this imaginary boxes right here on the screen. Here's your employer 401k. You move that money into your solo 401k. Pre-tax to pre-tax. Then you convert it to Roth. Here's the third box, right? Now it's in your Roth 401k. You pay taxes on that conversion. Anytime you go pre-tax to Roth, you pay taxes. So Todd, money goes pre-tax employer 401k, pre-tax solo 401k, pay taxes, Roth 401k. And then the final step, Roth IRA. Now you avoid RMDs. As you can see, this is a multi-step process, so you definitely want to make sure your tax professional can help you out there. But it's totally possible, and it's something you can repeat year after year over time. Just make sure you know that anytime you go from pre-tax to Roth, you're going to pay taxes. All right, guys, you are so great. I'm glad that we all have decided here that we're going to meet back here next week, same time, Same bat channel. I'll add a session here on this Q&A so you can come right back to this exact same URL. Or yeah, it'll be something like that. Same URL. I'll make sure it's posted in the network, solo401k.net. That's where we'll have the replay of today's session and upcoming session next week. If you've already submitted your question, you don't need to resubmit it. I've still got 22 questions that we're going to get to next week, and your questions will be answered. So we will meet back here next week, same time. Have an awesome rest of your week, guys.